Good evening. This is Ken Long from Tortoise Capital, and I want to review some swing trade frames using 2-hour and daily charts in the RLCO regression line crossover lens. The first one, we're going to take a look at a swing trade that we closed out today in XIV, and this is the inverse VIX ETF, so it goes up when volatility declines. Now, on a daily chart, what we've been doing is looking at the risk indicator, or the risk index, which compares the 30-period moving average of the VIX to the 10-period. And we know that when the 30 is greater than the 10, then it's favorable for the long side in stocks. And that means that the VIX is going down. And then we take the z-score of that reading and look over the last 5,000 days and then plot that as a time series here. And so back on June 26, when we first were really interested in this as a swing trade, and where we made our entry at 1860, when the ribbon on the 2 hours re-entered the river after being outside the floodplain, it then found support, and then the ribbon re-entered the river. And that's where we entered at 1860 with a dollar stop. Well, at that time, this risk Z, this time series, you can see it had made a double bottom down here at 1.5 standard deviations below the 5,000-day average. And so that, and it had started to actually hook up here. And so that looked like an opportunity to get short volatility, or long the inverse, long XIV. And notice that there's a pretty smooth quality to this oscillator, this risk Z. And so that felt like a low risk trade, especially after 3 or 4 days of finding support down here at the end of June. So we go ahead and enter at 1860 when price enters the river with a dollar stop. And then it gets to the mean, doesn't stop, gets out of the river, doesn't stop, hits the far edge of the floodplain, comes back, finds support at the edge of the river, and then just continues to move all the way up to 26, where it was today. So a move from about 18.5 to 26 is about $7 on 18, which is a pretty good move in about 20 trading days. Well, by the same reason, I get very interested in it when it's down here at an extreme stretch, in this case minus 1.5 standard deviations. On the daily report today, on July 23rd, you notice it's up here around 2 and is starting to stall a little bit. Maybe I'm reading into it. It hasn't rolled over. But when this thing turns, it can turn pretty fast. And the VIX on the other side gets really sharp moves in those first couple days out of an extreme low reading. And so this felt like a good time to close a trade at 26 and cash 7R. When we look on a daily, we'll see that it actually, for the first time in a while, it closed lower than the open, and it was at an extreme. So just some things to point out here is that this is what the VIX looked like, or the XIV looked like on the 2-hour charts in here as it was rolling over, and you can see there was slight improvement, these upticks in the oscillator. That's what this kind of formation looks like. And then this move from here all the way up to 26 looks like the move from this blue circle all the way up to this blue circle. So this is a month difference here between the risk Z chart, time series chart, and this one here. So the other thing to note is that when the inverse volatility trade is in our favor, you can hold this as a core position, and then intraday we were adding positions in turbo and carrying no overnight risk on the turbo. So we were keeping the core, but rolling with the turbo intraday, and we're able to leverage our interest and the time we'd spent on this research. So if we look at a daily frame, this is the source of my spider sense tingling up here. Back in April, mid-April, it peaked up at 25, went from 25, and look how sharply this thing, when this decays, it goes fast. It went from 26 to 19 in a matter of about a week, and then a rebound from 19.5 to 24, then a sideways quiet channel. Failure out of that channel allows you to get from 22.20 down to 18.30, and then even on a daily basis here in this blue circle, you can see the ribbon is outside of the floodplain. Then ribbon is improving. We're getting regression line crossovers in here, and our entry on the 2 hours allowed us to get in around 1860 inside this area rather than waiting till the daily gets to the back into the river, although that's still a good trade too. Then there was sort of this normal move back to this congestion zone, so that's why we drew this line here, and not surprisingly, not allowed to be surprised if it behaves in a normal way. We get this choppy, very volatile action here around 23 3/4 or 24, and then rather than reversing, it takes off for another leg up. So now we've got two nice legs up here to 26, and now inside this blue circle, right at the extreme edge of the floodplain, you notice we get a gap up, a sell-off, and a little bit of recovery, but it closed lower than it opened, and that's, in my view, that was enough reason to say, hey, this was a really good swing trade. It's extended pretty far. It's right at a level where it collapsed the last time it was here, and I know how to re-enter, so I'll go ahead and cash the core position at this time. And then the final thing is we'll just take a quick look over at the 2 hour frame on S&P, and really the S&P. Today's the first time since it crossed, when the ribbon crossed the 90 period regression line. That's the green one. After the regression line crossover and it gets through the Bollinger Band mean, and then it really never has come back. The first sign of price decay here in the relative strength of this trend is that now the regression lines, the 10 and the 30 and the VWAP and the price ribbon, have all crossed over the longer term, the 90 period regression line. So that's really the first sign of weakness. And the next stop is 168.50, which is a reversion back to the Bollinger Band mean. But I really think of this as the first real sign of weakness and slowing down and running out of steam since it left the river. I look at this as the choppy tactical trade in here, from the RLCO to the mean to the far side of the river, chops around a little bit. Nice to note that it holds at the Bollinger Band mean, holds at the Bollinger Band mean with a higher low. The river has turned, and now it's taken off, and this is really the beginning of trending behavior right here. And then there's been no real sign of weakness comparable to this until we get up in here, and it crosses back over the green line. So in my view, the very nice move that we've had off the bottom here, this swing low around 156 to 170-ish, is kind of at risk now. And I look at the market as in the best case, it enters a period of consolidation. You can see that how much volatility has come out. You almost have the beginnings of a sideways quiet channel, and so I want to be stalking that and be ready either for a retracement back to this 200 period moving average here, or a pause that refreshes and then the next leg up, and I'll be ready in either case on the breakout from SQC. But this looked like a natural place to put an end to that swing trade in XIV, and I think it's also reflected in slowing down just a little bit in the S&P here. And so we'll be ready to go in either direction, but I now have a shorter term time horizon because I think the easier swing trade is done. So that's Ken Long of Tortoise Capital on July 23rd, 2013. Keep your powder dry and your risk measured.